Hello, and welcome to Seize the Yield, taking a fresh look at fixed income. I'm Kim Gaxiola, certified financial planner and founder of Tech Girl Financial. I am so glad to have you here today and to see other people are just as excited about the fixed income opportunities as I am. This has all been spurred by the rapid rise in interest rates that began in early 2022, which has rejuvenated the fixed income yields, shedding light on many investment opportunities that haven't been seen in well over a decade. Investors who take a fresh look at fixed income may see a range of compelling options that have emerged across many types of bonds. So today I would like to talk about this and how it has come to be, as well as some of the reasons for optimism. So here are the things that we will go into is just a little background about what bonds are and how they fit into a fixed income portfolio. Higher yields, what that means for those seeking income generation, and also how increased income opportunities also leads to long-term total return. What will happen when we have an end to the rate hike cycle, as well as what the municipal bond market looks like, and also high yield. So in 2022, fixed income yields rose at the fastest pace since the early 1980s. One of the benefits of this acceleration has been the attractive income opportunities that investors may be able to take advantage of now. The amount of income an investment pays is typically measured by its yield. This chart shows yields over the last 30 years on the Bloomberg US Aggregate Bond Index. The Bloomberg US Aggregate Bond Index is similar to what the S&P 500 is for the stock market. It measures the broad market, how the performance is going, and the yields as well as pricing on bonds. You can see here after bottoming out at about 1% during COVID-19, yields rose sharply and have hovered above the long-term average for well over a year now. You would have to look back nearly 15 years for the last time that bond yields have exceeded the 30-day average of 4.22. For someone seeking income, this is a very significant change. Let me show you an example of what that means. Let's assume you have a hypothetical investment portfolio of $500,000 and you are to invest that money in the COVID lows versus December 31st of 2023. This chart shows how meaningful the increase is as income generated by an investment in different fixed income sectors, be it US Treasury bonds or core bonds, investment grade bonds, or high yield. You can see the effect of how rising yields have been both broad and meaningful amongst all the various income sectors. In each example, the income opportunity has at least doubled over the past couple of years. Many sectors have even seen income triple or more. The dramatic leap in yields has provided income-seeking investors with much more attractive opportunities than have been available in the last 15 years. In addition to providing investors with better yielding investment opportunities, the higher income that has been seen recently is also supportive of long-term total returns. Let me show you what I mean. Fixed income returns are derived from two sources. The blue, income return, this is what you get, what interest is paid from your bonds. And the green area, which is any price changes, positive or negative. It's also called the price return. When we look at historical fixed income total returns and break down how much came from income returns and how much came from price returns, you can see income dominates. From 1976 through 2023, 96% of fixed income total returns came from the fixed income earned while just 4% came from positive total returns. This is one reason why the higher yields that are now available for bonds has been so encouraging for fixed income investors. Yields have historically been one of the best gauges for forward returns for fixed income. The green bar at the bottom of this chart shows yields across several fixed income sectors as of December 31st, 2023. When yields have been at or near these levels in the past, defined as within 0.5% plus or minus, the average forward returns the next 1 year, 3 years, and 5 years have all been attractive. There can be no assurance that what has happened in the past will occur in the future. However, all else being equal, higher yields and higher higher yields and higher income benefit long-term fixed income investors. To combat rising inflation in 2022, the US Federal Reserve embarked on its most aggressive interest rate hiking cycle in more than 40 years. But what will happen once interest rates stop rising? Similar to the bull and bear markets that stocks go through, interest rates also tend to rise and fall in cycles. There's an inverse relationship between fixed income prices and interest rates. When interest rates rise, fixed income prices fall. Conversely, when interest rates fall, fixed income prices rise. Rising or falling rates can materially impact fixed income returns. We're going to talk over and over about the difference in price appreciation or depreciation based on the direction of interest rates going up or down. So remember that. It's very important to understand that dynamic, that it is an inverse relationship between interest rates and the price of bonds. So earlier, I showed you how income has a dominant driver of fixed income total returns over the long term. But in the short term, prices can significantly impact fixed income returns. This chart shows historical interest rates based on the Bloomberg US Aggregate Bond Index. Since 1976, there have been 10 rising rate periods averaging 30 months. If we focus just on these rising rate periods, you can see in the table that fixed income returns have struggled with slightly negative returns during those periods. Similarly, there have been 10 falling interest rate periods, which have lasted 28 months on average since 1976. However, during those falling interest rate periods, returns averaged 15%, a significant difference. The most recent period has decidedly been a rising interest rate period, which began back in the summer of 2020. However, many professional fixed income investors believe that most recent rising rate cycle peaked in October 23 as rates finished the year broadly lower. If we have entered a falling interest rate cycle, it may provide a strong tailwind to fixed income returns. A powerful influencer of interest rates is the US Federal Reserve, or Fed for short. I'm sure you've heard them talked about many times in the financial news. While the Fed doesn't control interest rates, it does have the authority to change on the Fed funds interest rate. This is a rate that banks charge one another for lending cash on an overnight basis. Changing the Fed funds rate can pressure banks to adjust their other interest rates, such as the rates they charge for credit cards, mortgages, auto loans, and how much interest they offer on your savings deposits. In the current cycle, the Fed has already raised the Fed funds rate 11 times in an effort to fight persistently high inflation. As inflation has begun to moderate, there has been a lot of speculation when the Fed will finish raising the Fed funds rate, and for good reason. Going back to 1990, in the 6 and 12 months prior to the Fed funds rate peaks, fixed income returns struggled. But for the 6 and 12 months following the Fed funds rate peak, fixed income returns accelerated. The Fed's rising rate campaign also created substantial volatility in bond markets, as measured by the MOVE index. If you've ever heard of the VIX, which is the volatility index for the equity market, the MOVE index is similar to this, but it's for the bond market. Much like the stock equivalent VIX, the MOVE index uses options pricing to measure expected volatility. Historically, when the MOVE index volatility normalizes from elevated levels, and elevated is anything greater than 100, subsequent 12-month returns have been strong and above average across many fixed income sectors. As of December 31st, 2023, the MOVE index was elevated at over 114, which could be good news for fixed income investors once the volatility begins to subside. For investors who might be unsure whether interest rates will continue to rise or begin to fall, there can be a desire to just hold cash and wait. In the past, this has proven costly. This table looks at when bank certificates, or CDs, reach their highest or peak rate in a market cycle. Intuitively, an investor might believe placing money in a CD when rates are at their highest level would be a sound investment strategy. But by definition, CD rates hit their peak. They only have one way to go, down. And what happens to fixed income prices when interest rates go up? And what happens to fixed income prices when interest rates go down? Prices go up. Unfortunately, CDs and other cash investments like money market savings accounts typically do not benefit from any price appreciation when interest rates fall. They only pay income. What's more, holding CDs or other cash investments carry reinvestment risk, or the risk that an investor may not be able to reinvest at the same yield upon maturity. Interest rates can fall just as fast as they can rise. However, most fixed income investments pay income and offer the opportunity for price appreciation when interest rates fall. And as you can see in the table, that has made a meaningful difference in the past. CDs have often been the worst performing asset class 1 year after their rates peak. But what if rates don't fall and instead continue to rise? It's only hindsight that we can truly know when rates have peaked. So it's good to understand what might happen if interest rates continue to rise. This chart shows what the expected return would be for different fixed income sectors if interest rates were to rise an additional 1% or fall by 1% from where they were on December 31st, 2023. You can see that if rates continue to rise, some fixed income classes would experience negative returns while others still remain positive, thanks largely to the higher income generated and lower duration. Duration measures an investment's sensitivity to interest rate changes, and lower durations typically help when rates are rising. A lower duration is something that either has a very short-term time to maturity, as well as they are in very conservative, high credit rated investments. A longer duration typically has to do with riskier holdings and ones that have a much longer term to maturity. So if interest rates were to drop by 1%, you can see the strong returns that would be expected. When interest rates fall, fixed income prices rise, so investments with higher durations or sensitivity to interest rates benefit more. For some, the downside risk of a smaller gain or even a possible loss if rates continue to rise may be offset by the potential gain achieved if interest rates have peaked and will start to fall. Higher yields and the resultant income they produce can help buffer against investment losses should interest rates rise just a little higher. Historically, periods of poor fixed income performance have been followed by strong rebounds. This chart shows the 5 worst performing periods for fixed income and the subsequent 2-year cumulative returns. The most recent drawdown period that ended in October 2022 was by far the longest and worst stretch for fixed income. After a lackluster recovery for most of 2023, fixed income returns vaulted higher in December after the Federal Reserve hinted that interest rate cuts might be coming sometime this year. Even with the late year rally, past recoveries show that the most recent fixed income rebound may have further to go. It's also important to remember one of the primary reasons for investing in fixed income is that it has been good diversifier to risk assets, such as stocks and equity securities in the past. When you look at fixed income returns by year, you can see they've been positive 90% of the time back to 1976. The propensity of fixed income investments to deliver positive returns has often provided a stabilizing effect for portfolios, offsetting poor returns from other allocations, particularly equities, which have historically fluctuated up and down more. And when you look at fixed income returns over rolling 5-year periods, all of them have been positive. The income cushion provided by today's elevated yields may help reinvigorate fixed income's traditional role as the portfolio diversifier. Another way to illustrate this is to look at the range between the best and worst calendar year returns of equities and fixed income. The best calendar year performance for each has been impressive. Perhaps more importantly, however, is the worst year for each. Equity's worst calendar year performance was almost 3 times as bad as fixed income's worst year. For those who struggle with the ups and downs of equity markets, an investment in fixed income may help smooth the ride by lowering overall portfolio volatility and help investors avoid panic selling at inopportune times. Lower overall volatility is helpful, but what's really critical is how fixed income performs when equities are at their worst. Excuse me. These are the 5 worst equity market events since 1976. They represent the periods when equities dropped more than 20%. In 3 of these periods, fixed income delivered a positive return when equities were at their worst. These negatively correlated periods are exactly what we hope for fixed income investments. In the other 2 periods, even though fixed income returns were negative, they still performed significantly better than stocks did on a relative basis. The inflation crisis of 2022 was a very volatile and unpredictable environment where the negative correlations between fixed income and equities completely eroded. The combination of low starting yields and rapidly rising interest rates punished fixed income in a way that hadn't been seen in nearly 50 years. Many pundits argued that fixed income's effectiveness as a portfolio diversifier may be over. However, with yields now at more normalized levels relative to the last decade and poised to deliver higher income, it may be premature to discount fixed income's diversification benefits too quickly. For retirees living off their retirement savings, a fixed income allocation may be even more important. The income generated from fixed income investments can help retirees avoid forced selling of equity holdings to supply the regular distributions that they're relying on. Imagine an investor who retired at the start of the year 2000 with 1 million saved, decides to follow the 4% rule and withdraw an initial 40,000 from their portfolio. This will happen once a year, but to account for inflation, the withdrawal amount will increase every year by 4%. Investing only in equities, this retiree would have run out of money by 2021. The market volatility caused by the dot-com market crash in the first years of their retirement meant that the retiree was forced to sell when equity prices were depressed. The market eventually recovered, but with the addition of annual withdrawals, the retiree's portfolio didn't. An equally weighted portfolio invested in 50% equities and 50% fixed income fared much better. By the end of 2023, The portfolio was in relatively good shape, having distributed more than 1.5 million in income, with a remaining balance of more than $680,000. The income from this fixed income portion of the portfolio meant that fewer equity shares had to be sold in a bad market to meet the annual distributions in the early years when the market and economy struggled. For retirees, fixed income may make the difference between running out of money or having a comfortable retirement. The fixed income market is vast, with more than 1 million individual bonds that span many sectors. However, one sector that may be particularly attractive for investors now is municipal bonds. Municipal bonds are those bonds that are issued by either state governments or local municipalities. They're usually to support creation of a tollway or many other different projects. Some have to do with building stadiums. There's lots of different municipal opportunities out there. Municipal bond yields dropped sharply also in 2023, but remain well above their 10-year average, providing more income than in past years. One of the biggest benefits of municipal bonds is the income is typically exempt from federal and sometimes state income taxes. The effective yield an investor receives can be much higher depending on one's marginal tax bracket. For our clients, this is one of the things we do often is really look at our client's tax bracket and see whether municipal bonds will offer a higher taxable equivalent yield than regular bonds would that would normally be taxed. One of the concerns with municipal bonds is the credit rating of the state or the municipality and making sure that they're going to be able to pay those bonds back at the end of their maturity. But many states are in much better financial condition today than they were during the depths of the COVID-19 pandemic. Since 2021, 45 states have maintained or improved their credit ratings. If the US economy were to enter into a recession, it could adversely affect state finances. However, like other borrowers, many states and municipalities took advantage of lower interest rates a couple of years ago, and some currently have very large rainy day or emergency funds from which they can draw as a cash cushion against an economic slowdown. Municipal bonds have rarely suffered from negative cumulative returns. It's actually only happened 6 times in 42 years. Historically, municipal bonds have tended to bounce back strongly following down years. So far, the muni rebound following 2022 has been tepid, but could get a boost with the Fed signaling interest rate cuts may be coming in late 2024. Municipal bond investors often sell their holdings when yields rise and peak, which can be detrimental to their longer term returns. Typically, the best time to buy municipal bonds is when interest rates peak. An investor captures the higher income and may also benefit from price appreciation if interest rates begin to drop. Starting in 2022 and continuing through most of 2023, municipal bond funds experienced the longest and most significant outflows since the global financial crisis. Historically, sizable muni inflow cycles and stronger performance have followed large outflow cycles. Municipal bonds are currently offering investors compelling yields and opportunity for price appreciation if interest rates fall. A tax-free advantage, low historical default risk compared to corporate bonds, and strong fundamentals. Now let's talk about high yield. For investors worried about recent equity valuations and the possibility of an economic slowdown and recession, a reallocation to high yield bonds may be something to consider. A lot of times we use high yield bonds as a replacement for stocks because they are less sensitive to a recession and market movement than stocks. High yield bonds are those bonds that are typically issued by corporations but the risk of them paying back their principal is higher. And so, to compensate for the higher risk that you're taking, they generally have a higher level of interest paid. Yields on below investment grade bonds have been hovering at elevated levels versus their 10-year average, offering an attractive income opportunity that better compensates investors against potential default risks. Many corporations with sub-investment grade ratings took advantage of the low interest rates experienced during the COVID-19 pandemic, borrowing at very low rates and extending repayment schedules. Currently, less than 10% of high yield debt will mature before the end of 2025. Thus, most issuers are unlikely to feel the effects of higher interest rates until 2026 or beyond. This may help keep default rates lower than they otherwise would be. With the potential threat of a US recession on the horizon, investors may benefit from reallocating some of their equity exposure to high yield bonds. In past recessions, high yield bonds perform better than stocks during recessions and for the 18 months after the recession ended. An allocation to high yield bonds has historically provided investors equity like returns with lower overall portfolio risk and immediately after recessions. So we've come to the end of the presentation, and I thank you for staying here all of this time. This presentation was created by Franklin Templeton, and I'm grateful to have them as a money manager that offers their research and material to us. Please know we have very different money managers for us to work with when it comes to putting together bond portfolios. We are under no obligation to work with Franklin Templeton and remain unbiased and objective when it comes to finding the right solutions for our clients. Today's higher yields have opened up potential opportunity for investors to collect attractive income, generate better total returns, and add diversification to their portfolios. Franklin Templeton has a broad bench of managers that offer specialty in the fixed income space. We at Tech Girl Financial are constantly looking at the opportunities that are available for our clients and making sure that their portfolio stays relevant to what's happening in the future in the next 24 months, 5 years, 10 years, and beyond. So if you're wondering how all of this pertains to you, I welcome the opportunity to have a conversation with you, and we can discuss how this may be of value to you. So I just want to thank you for your time. And I have some slides here at the end, which are just going over some of the characteristics of bonds. If some of that information was confusing to you, think of a bond just like you would think of your mortgage loan, something where you are borrowing from the bank. In this case, it may be a corporation borrowing from investors and paying a stated rate of interest back. So if you have more questions and really want to get into the details of how bonds work, I am always here and love to educate on these topics. Don't ever hesitate to reach out to us. Thank you for being here.